Let's talk about staying with the economy. Packaging Corporation of America. This is can I call it a cardboard company? Is that too
It's
simplistic?
corrugated boxes, if you recall.
I do remember we looked at a company like this. Maybe it was even this company, and it's so fun about investing is you learn so much. And these are some of the segments that I do on Fox and KSI. Is I talk about different things that sometimes are not with investing, but it's things we learn about companies. And if you're investing in companies and stock and you don't understand this stuff, you should not be investing because things can change very quickly. And we do a lot with the numbers, but you also have to understand the business as well.
Yeah. And I remember we looked at this several years ago, and you would think they would benefit maybe from like an Amazon type situation because we're using so many boxes. Well, obviously Amazon.
And box in a box many times, which is crazy.
And Amazon now, they use a lot of those poly bag sleeves, little ones, but they kind of focus more almost on promotional packaging. They work with a lot of like packaging for meat, fresh fruit, vegetables. So you go to the grocery store, you see those, boxes there. I mean, it's not necessarily the boxes that you envision when you go open the Amazon box. I think that is to a degree what they do, but it's not really where they generate most of their sales and income.
Well, and they are in the industry of packaging and containers, so kind of puts them there. Float is only about 4.7%, so people aren't expecting this to drop dramatically. It is almost 99% institutional owned. People don't hold this individually. They like the institutions to hold it. PE ratio, 27.1. Now, that is below the industry at 36.4, but still, I got to call it expensive. Price to sales, 2.3 versus 1. Price to book value, 4.4 versus 1.9. And then price to free cash flow, or price to cash flow, 14.5 versus 9.8. So again, expensive company based on the valuation ratios. You want them lower than the industry average. We do see a PEG ratio looking pretty good, 1.7 versus 10.7, so that's pretty good. The earnings over the last year, well, they're up 10.9%, almost double the industry at 5.9. Sales did increase by 4.6%, and this was not nearly as good as the industry. The industry sales growth was up 20.9% over last year. However, the analysts give a 5-year earnings per share growth estimate for packaging, PKG, Packaging Corp of America, of 12.9% going for the next 5 years, above the industry at 8.3%. So seems to be some good things going on there. Dividend, they pay a decent dividend, 2.2%, only use 50.3% their earnings to pay that out. Look at the balance sheet, got a current ratio of 3.2 versus 1.7, so a lot of liquidity there. That's a positive. Debt to equity, not bad, 0.9 versus 1.1. We do see a net profit margin of 10.2. That's well above the industry of 4.4, so that's a positive. Return on equity, 18.7 versus 5.7. Free cash flow is $725 million, not quite double the industry at $400 million. So I'm kind of liking on the balance sheet, looking pretty strong here, but we got to make sure that they're worth it based on the earnings.
Yeah, it was kind of interesting. This company in particular, and along with the other, packaging and pulp products makers, they did fall last Friday as I guess pricing for domestic container board declined to $20 a ton in February. So they got hit last February. They were around like 237. They dropped down to 220, but it regained a lot of that this week as Packaging Corporation of America in particular. They closed at $232.14 on Friday. 52-week range, though, the low $172.72 and the high $249.51. Unfortunately, you go forward for this company, you got to December 2027, estimated earnings per share here, $12.21. It gives a target sell price of $202.69, so below that current level of, again, $232.14.
We still seem to be in a situation where things are kind of expensive. We look and, we have seen some things pull back. Again, the software companies, I'll pick on them, starting to see maybe technology come back a little bit. But it really has a long run to go. I mean, when you look at even this company, Home Depot, Costco, companies that are way overpriced, they seem to be hanging on.
Well, Costco, they in particular, they didn't do well last year, but now they've kind of recouped some of the losses last year, and now they're trading around 50 times earnings again. It's just, you have a lot of, I'm going to say, froth and expensiveness in this market, and it's not just in technology.
And I think people forget, I know Costco, I go there and I see it packed all the time. Yeah, that's part of the equation, but it always does come back to the numbers. Eventually, it's what you're paying for the earnings, and paying 50 times earnings. I always tell people, think about that. That means it would take you 50 years to make back what you pay in that stock based on those earnings. Now, yeah, the earnings will probably grow, but even with that, it still makes no sense.
Sorry, I over counted Costco. It's at 44 times future earnings.
Okay, 44, 50, about the same thing.
Yeah.
You know, you're still pretty high there. It's not like
I
a
think-
24.
And Walmart also, I mean, it's kind of gotten lumped in with what I'll call the safety trade, the defensive trade. It's like, oh, Costco, Walmart, we got to get out of tech and into, safe consumer defensive businesses. But yeah, Walmart's at about 38 times future earnings. These companies, in previous kind of market difficulties where we look at the tech boom and the subsequent bust, they did well during those time periods when things were kind of difficult for technology. But historically, they didn't trade at valuations in the 40s. I mean, that is just that's tough.
Yeah, I worry. Did I cut you off, or did you finish with?
Yeah, I finished.
Okay.
Yeah, it was a sell. It was overpriced.
Yeah, because I did look too at the earnings per share for December 2027. I think you said around $12.28. There's 7 analysts, and the range of those estimates are pretty wide. $10.67 the low, the high $13.67. So that's another thing too. It tells me that's not very strong. That they may not get that 12.28. They can miss that by a fair amount. So all these important things to look at, and people wonder, well, what do you do? Take you 10, 15 hours to look at a company. There's so many things to do, so many things to understand. That's why if you buy a stock and it's like you took we'll say a half hour to research it and then you bought it, you've missed a lot. You be prepared for a surprise down the road someday.
Yeah, and I will say there are some industries that you are going to have a wider range, and I'm not going to say that makes us like the stock more, but I mean, it makes sense, right? Like we'll go back to Lidos, like their input costs might be a little bit more straightforward, and I don't know the business through and through, but generally companies like that, your variable expenses aren't going to be as hard to predict out, where a company like Packaging Corporation of America, I mean, the container board and the pulp and everything else, you're going to have a lot more variability to those variable expenses. So it is harder for the analyst to give you a firm number because they're not even just projecting out necessarily how the sales are going to look and what the business lines are going to look like. It's now what is the variable cost going to be to that business. So I don't want to give it a pass in terms of the wide range of analysts, but a business like that, I think it is going to have more variability to the analyst estimates.
So many things to understand with it. That's why you look at many different factors there. But